Dr. A.G.Mythili, Assistant Professor, Department of Commerce with Finance, Dr. SNS College of Arts and Science. Here we are going to see about case study analysis. So here the summarized balance sheet of a concern as at 31st December is given. Liabilities consist of 6% preference share capital, equity share capital, general reserve, profit and loss account, 5% debentures, sundry creditors, bills payable, and assets consist of goodwill, land and building, machinery, furniture, stock, sundry debtors, cash at bank, preliminary expenses. Other informations given are total sales is 4 lakhs, 20% of which is made on credit. Gross profit and net profit after tax for the year ended are 80,000 and 20,000 respectively. We have to calculate different ratios and we have to comment on the financial performance of the concern. So we have to calculate current assets. So current assets include stock, sundry debtors, cash at bank, preliminary expenses, and current liabilities includes creditors and bills payable. So current assets ratio equal to current assets by current liabilities. 1,16,000 divided by 40,000 will give 2.9:1. Next is liquid ratio, liquid assets by liquid liabilities. So it is 0.65:1. Proprietary ratio, proprietary is fund by total asset, 4,11,000 divided by 5,51,000, that is 0.75:1. Fixed asset proprietorship ratio, fixed assets by proprietary equity, 4,35,000 divided by 4,11,000, 1.06:1. Debt equity ratio, total debt divided by proprietary equity. So 1,46,000 divided by 4,11,000 is 0.34:1. Capital gearing ratio, formula is equity share capital divided by preference share capital plus debentures. 2,50,000 divided by 2,50,000 is 1:1. Gross profit ratio is gross profit by sales into 100. 80,000 by 4 lakhs into 100, 20%. Net profit ratio, net profit by sales into 100. 20,000 by 4 lakhs into 100 is 5%. Stock turnover ratio, cost of goods sold divided by average stock, that is it is 2.6 times. Debtors turnover ratio, debtors by credit sales into 365, 21,000 divided by 80,000 into 365 equal to 96 days. Return on proprietors fund, net profit after tax divided by proprietors fund, that is equal to 20,000 divided by 4,11,000 is 0.05:1. Turnover to fixed asset ratio, turnover divided by fixed assets equal to 4 lakhs divided by 4,35,000 equal to 0.92:1. So here liquid assets include sundry debtors, cash at bank. Fixed assets include land and building, machinery, furniture. Proprietors fund include equity share capital, preference share capital, general reserve, profit and loss account. Total debt and outsiders liabilities include 5% debentures, current liability. Shareholders equity is proprietors fund minus preference share capital. So total asset equal to total fixed assets plus total current assets. So now coming to the comments, liquidity and solvency portion of the firm. Current ratio is 2.9. It means the current assets of the 2.90 are available against each rupee of current liability. The portion is satisfactory on the basis of current ratio. However, the liquid ratio is 0.65:1. It means greater part of current assets constitute stock. The stock is slow moving. Therefore, liquidity portion is not satisfactory. So coming to the credit terms, the collection system is faulty because debtors enjoy a credit facility for 96 days, which is beyond normal period. So there will be shortage for working capital. The performance of debt collection department is poor. Profitability, gross profit ratio is 20%, which is healthy sign, but the net profit ratio is only 5%. It means the operating expenses are higher. Investment structure, debt equity ratio is 0.34:1. It means the firm is not dependent on outsiders liability. The portion is satisfactory. Capital gearing ratio is also satisfactory. However, the fixed assets to proprietorship ratio reveals that the entire fixed assets were not purchased by the proprietor's equity. It means that the firm depends on outsiders liabilities. It is not desired. Coming to the return on proprietors fund, 5% of sales is the net profit and are available for the proprietors. The state of low stock turnover ratio and turnover to fixed assets indicates an unhealthy sign. Fixed assets are not used properly. It is a sign of undertrading. The economic conditions of the firm is not sound. The firm can increase the rate of return on investment by increasing production. So the overall performance of the firm is satisfactory.